Every successful trader has one thing in common, an edge. Without it, you're just gambling. But did you know there isn't just one type of edge? There are actually four. Today I'm breaking down these four market edges and how you can leverage them to become a consistently profitable trader. Let's get into it. The first type of edge is informational edge, having access to better or faster market moving data than others. This is where hedge funds and institutions dominate. They use satellites to track retail shipments, scrape credit card transaction, and pay millions for high frequency trading infrastructure that gives them milliseconds of advantage. If you think you're competing with this one, you're not. What retail traders need to understand, you don't have informational edge. Hedge funds do, accept it. Avoid chasing mainstream news. If it's on CNBC, it's already priced in. Your true informational edge, knowing that you don't have one. Stop searching for secret data, focus on reliable, accessible information, and making decisions based on it because you know it's accurate. The mistake most retail traders make is believing they have an edge when they don't. The best thing you can do is avoid being fooled by fake signals and focus on what's actually in front of you and what you can trade, the price. The second type of edge is analytical edge, your ability to interpret data better than your competition. The good news, access to the data is cheaper than ever. A decade ago, this level of data would have cost millions of dollars. Now you can get it for $50 a month. But just because you have access to the data doesn't mean you're using it correctly. How do you develop this analytical edge? First, you need to understand exactly what you're testing. A back test is worthless if you can't explain why the strategy works. What I like to say is more lies have been told in Excel than have been in Word. Just because a model looks great on a spreadsheet doesn't mean it works in real life trading. One way to truly test an edge is by combining different strategies in a portfolio, such as going long the worst performing option in the chain and then shorting the best performing option in the chain to create a natural hedge and seeing if that volatility is priced accurately across the entire chain. This type of structure ensures that you are not relying on a single data point and it is most likely not curve fit, and it's a repeatable, risk-adjusted approach. Match your backtest to reality. If your live trading results don't align with your backtested data, your edge is a complete illusion. Leverage cheap data, but don't assume it's unique. If you found a simple indicator that works with a $50 subscription, someone else has that too, I promise you. Simple is good, and that is a tool in your tool belt for your portfolio, but every strategy will fall in or out of favor. The key is to find the right sizes for each of these trades and how they pair with one another. Too many traders confuse backtest with actual edge. The edge isn't just running a backtest, it's understanding why the strategy works and how it holds up in live trading. If you don't have that, you don't have an edge. You have an expensive guessing game that won't be repeatable and you will not be able to stick to. The third edge is executional edge, your ability to execute trades better, cheaper, or faster than others. This is an area where institutions dominate, but retail traders can carve out a unique advantage. Ways to gain the executional edge. By gaining lower trading costs through higher volume, traders get discounted commissions, which adds up over time and aids in compounding. If your execution costs are lower than the next trader, that's an edge because each trade starts out a little more profitable than for other traders. Faster order execution. If you're trading at a larger size, your ability to execute without moving the market actually is diminished. High frequency traders spend millions to reduce execution time to mere milliseconds. While you don't need that level, you do need to understand how to best get the best fills with using orders that are consistent and work in times of market distress. Flexibility as a retail trader. Large funds can't trade small caps or illiquid options without affecting price. Retail traders can. Warren Buffett can't buy a $200 million position in a microcap, but you can take a $10,000 trade as a retail trader or trade options instruments and have access to liquidity to scale with your portfolio size. If you're trading a small account, you have an executional edge just by not being a hedge fund. You can move in and out of positions with ease and have access to liquidity and are often first in line, while they have to tiptoe in and out of liquidity as large institutions. Knowing how to capitalize on size flexibility is a key advantage that you can use as a retail trader. The final and most important edge is behavioral edge. This is the one that retail traders consistently overlook, but is by far the most robust over any period of time. The market is driven by fear, greed, impatience, and sentiment. If you can control your emotions and exploit others' mistakes, you have a seriously large edge. Studies dating back to 10th century Japanese rice prices show that price movements and trend following strategies work because human nature remains consistent. Traders over-exaggerate greed and fear, which is exactly where risk premium comes from and why it will never disappear. This behavioral pattern has repeated itself for centuries, from early commodity trading to modern markets. How to build out your behavioral edge. Develop extreme discipline. Sticking to your system while others deviate is an edge. Exploit market overreaction. Panic selling creates opportunities, extreme greed leads to mispricing. Trades based on probabilities, not emotions. The best traders make decisions based on numbers, not gut feelings. But here's the catch. You only get to realize the edge if you can handle it. It's not just about having a great strategy, it's about having the conviction to stick up with it through an inevitable ups and downs of trading that strategy. Optimize for conviction is just as important as optimizing your strategy for profitability. Most traders lose not because they lack knowledge, but because they can't control their emotions. If you can master patience and discipline, you already have an edge over 90% of the market. So there you have it, the 4 types of edge in the market: informational, analytical, executional, and behavioral. The best traders combine multiple edges to dominate the market. Which edge do you think is most powerful? Let me know in the comments, and if you want to sharpen your skills even further, subscribe to my channel.